Right. I'll turn it over to your team.
All right, welcome everybody. This is exciting to be offering this presentation today. Compliance Systems is getting more involved with Michigan Bankers Association, so we'll look forward to seeing you all throughout the year. But just a little bit on Compliance Systems. We've been around 30 years. We're based out of Grand Rapids, Michigan. For those that aren't as familiar, Compliance System Solutions are focused on being delivered through our over 50 different deposit and lending origination system partners. So all the major core companies, independent loan origination companies, online banking, digital banking solution providers. So our area of expertise is providing solutions for a bank to document any transaction between itself and your member, customers and borrowers. We do that throughout our legacy of time, and still is our very much focused is through advanced technology. The line of business is pretty depth, across deposits, cross lending, online banking, treasury management. And I'm just gonna pause there because did we lose the presentation? I think it paused sharing, Stephen.
I'm struggling to get rid of a pop-up there, so I apologize. Give me just a quick moment.
Yep, that's okay. While you're doing that, I can kind of finish the introduction. But yeah, so we definitely have our solutions focused on being delivered as advanced technology and through those integrated partnerships. We don't go to market with our own platform system. So we're very much subject matter experts in the areas of compliance across those lines of business. We have over 1,800 clients across the country of all sizes, from community banks to tier 1 institutions. So later on at the end of the presentation, I'll touch a little bit more on, what is our kind of differentiating aspects of our solution compared to other options, but really give you some insight into how that solution set really carries across to serve and scale like that. But want to get to the heart of the matter. And so Stephen and Bill will kind of take it from here to dive into section 1071.
All right. Thank you so much, Julie. Give me just a moment, everybody. I apologize again. I'm going to reshare my screen for the presentation. I apologize for this technical difficulties. Does that look good? Okay, thank you, Bill. All right. So no, thank you very much, Julie. It's a pleasure to be here with everyone today to go into the Dodd-Frank Act. So just quickly an overview of everything we're going to talk about today and share with you today. First, we're going to talk about what is the Dodd-Frank Act, what is Section 1071 of the Dodd-Frank Act. Brief history of Section 1071 and the rulemaking and sort of how we've gotten to this point. A summary of the final rule, some key definitions, the requirements for data collection, what is a firewall, the sample data collection form provided by the CFPB, and some other topics, including website notice and the compliance timeline. And then to wrap up with Julie's, will wrap up at the end for us. So what is Section 1071? Well, Section 1071 was included in the Dodd-Frank Act, which was passed in 2010. The primary purpose of the Dodd-Frank Act is to promote financial stability in the United States by improving accountability and transparency in the financial system. Section 1071 is actually a section of the Dodd-Frank Act. And what it did was it amended the Equal Credit Opportunity Act to add a new section to require financial institutions to collect and report data on applications for women-owned, minority-owned, and small businesses to the Consumer Financial Protection Bureau. And you might be asking, well, this was back in 2010. I thought Dodd-Frank was pretty well settled. Why are we now talking about a brand new regulation with respect to Dodd-Frank Act here 13 years later? And the reason for that is that at the time that this was passed, Dodd-Frank made an opinion that with respect to 1071, that it wasn't enforceable until they promulgated a rule concerning it. And so up until now, they have not done that. So what is 1071? What's its purpose? Its purpose, there's two purposes: to facilitate enforcement of fair lending laws and to enable identification of business and community development needs and opportunities for women-owned, minority-owned, and small businesses. Section 1071 gives the CFPB broad authority to do that. So in addition to various statutory requirements or data points required in the rule, they also have the ability to add additional requirements or additional data points. And we'll talk a little bit more about that later. Why it's important, or what is the CFPB trying to do with this, or why are people maybe interested in Section 1071? Well, essentially what policymakers are trying to do is they're trying to determine whether small businesses can get access to affordable credit and what disparities may exist. And not just access to credit, but also equitable access to credit. So even if credit is being issued, is it being issued in an equitable manner with respect to small businesses? And this is important because small businesses drive economic growth and job creation. They create about 2 out of every 3 jobs. And just a few figures, there's an estimated 10 million people employed by women-owned businesses, generating nearly 1.8 trillion revenue each year. And in 2020, there are estimated about 140,000 African-American owned businesses with 14 billion in annual revenues. So it's important to the CFPB and other stakeholders who are interested in this regulation that they get these data points so that they can assist these businesses and small businesses to continue to have a positive impact in the financial industry. So just a what might the CFPB or other stakeholders be curious about, and why might this be important? Just another a fact for you. The National Small Business Association recently did a report, and they asked some questions. They asked small businesses if their small businesses were able to obtain adequate financing, and about 37% of them said no. So that's it's not more than half, but it's still a large number. And of those people, of those businesses, they asked, what effect does that have on your operations if you're unable to access that credit? And in 2023, 45% said that that means that they're unable to grow their business. So this is important to the CFPB and part of the reason why we're here. So we can talk about the rule itself and the history of the rulemaking. Why is it now, now we're getting the rule today? How did we get here? Well, up until about 2019, there was no action on the part of the CFPB, and there was no effort to promulgate any rulemaking for the statute. But in 2019, there was a lawsuit by a community activist group against the CFPB that alleged that they were unlawfully and unreasonably delaying enforcement. And the CFPB agreed in February 2020 that was the case, but that they were going to go ahead and begin efforts to get a rule in place. They started making efforts. They did a symposium in November 2019 as well, and a cost survey in August of 2020 to gather information and get feedback from various stakeholders on what a final rule could look like. And this really kind of took it really kind of gauged the stakeholders from either end of the spectrum. One end saying, that the CFPB, we'd like the rule to be very narrow because we don't want it to have a chilling effect on issuing small business loans if the regulation is too burdensome. And the other end of the spectrum saying, well, the purpose of Section 1071 is to get this data, and we need as much data as we can get from these applications so that we can fulfill the purpose of the statute and help small businesses women-owned and minority-owned small businesses as well. So after that symposium, after they issued this Small Business Regulation Enforcement Fairness Act report, they summarized their efforts, and in September 2021, they issued a proposed rule. In January 2022, the proposed rule expired, and the comment period, I should say, expired. At that point, there were over about 2,000 comments that had come in from institutions across the country, banking agencies, and other stakeholders making their comments about the proposed rule. A lot of it was negative, that the rule was too strict or too burdensome and would have a negative effect. July 2022, we fast forward, the CFPB still had not issued a final rule. They were still delaying, but they met a settlement or court order and agreed that by March 31st, 2023, they would have a final rule in place. And so March 30, 2023, the final rule was issued. So what is the final rule? The final rule says that a covered financial institution shall compile and maintain data regarding covered applications from small businesses. In the final rule, they provide key definitions, instructions for collecting, reporting, and maintaining the data, a sample data collection form, and safe harbor in the event of bona fide errors in attempting to meet the regulation. So let's talk about the key definitions and what they are. And this is really the heart of the issue. These several definitions are really key to understand whether you're going to be required to report, but also what to report and how to report. So the first definition is, what is a covered financial institution? A covered financial institution is an institution that originated at least 100 covered applications or covered credit transactions from small businesses in each of the 2 preceding calendar years. So that is different from the proposed rule. In the proposed rule, they had initially proposed that it would be institutions that originated 25 credit transactions in the previous 2 years, but they did increase that. So this has the effect of potentially helping smaller community banks or credit unions from having to that don't do a lot of business credit from having to comply with the rule. Importantly, though, the term financial institution means any financial institution. So while there were several types of institutions that may have wanted to, for example, credit unions were requesting to be exempted from the rule, the CFPB took the approach of not exempting any institution type. So essentially, any banking institution, any partnership company, corporation that engages in financial activity and that extends business credit is going to be included in that definition of financial institution. A covered credit transaction is also a very broad definition, and it simply means, unless excluded, an extension of business credit. And so this is important because this doesn't necessarily just mean C&I or commercial real estate or large commercial credit transactions either. It means any business credit that's being extended. So this could be term loans, credit cards, and things of that nature too. When it comes to small business, there was also some back and forth on what would be considered a small business. There wasn't really a definition out there for small business, so there was some commentary on trying to limit what the size of what a small business is, and therefore maybe limiting the number of applications that you have to track and report on. But ultimately, what the CFPB settled on was that a small business means a business that has gross revenue in the preceding fiscal year of $5 million or less. They do exclude nonprofit organizations and government entities that are requesting credit. This cap, though, of 5 million, it can be adjusted for inflation or deflation starting in 2030. And finally, what is a covered application? A covered application is simply an application, either oral or written, by the applicant for a covered credit transaction made in accordance with your procedures, or the financial institution's procedures, for the type of credit requested. It does not include things like renewals and extensions, and it also doesn't include things like firm offers or credit line increases, things that the borrower did not actually request and that may be made automatically. Also excluded from the definition of covered credit transaction are things like trade credit, HMDA reportable transactions, which is also a change from the proposed rule, included HMDA transactions initially, but now those are excluded. Insurance premium financing, public utilities credit, securities credit, incidental credit, and the commentary also clarifies that things like factoring, leases, and consumer designated credit that may be used for business or agricultural purposes are also excluded. So this is credit that is designated as a consumer credit for primarily household use, but may also be used as business credit.
One thing to note here, Stephen, is with all of the collection and reporting that's going on for financial institutions nowadays, I think it's interesting to note that there is, I believe there's some proposed changes that are coming down the line for CRA, such that information and data that's collected for small businesses, and I think for agricultural operations that are collected through this 1071 would then satisfy some of the collection of the CRA. So just something to keep in mind and keep an eye out for coming down the pipe.
All right, thank you, Bill. Now I'm going to skip this one and come back to it. So let's talk about the actual data points. In the proposed rule, well, in the regulation, there are 13 mandatory, quote unquote, data points. But the CFPB has added several as well, in addition to those 13. We call those discretionary data points. And they've done that to further their purpose, or Section 1071's purpose. When you look at the data points that are going to be required to be collected and reported, there are sort of three different buckets you can put them into. One is institution-generated data, which is data that you're going to generate automatically just by doing the application anyway. So something like a unique identifier, an application date, when it was taken, the action taken, the method that it was taken. Those things are sort of similar, maybe even to what you see in HMDA. There is a difference, though, when it comes to something, for example, like the action taken. When it comes to an incomplete application, HMDA requires you to send out a notice that it might be an incomplete application, whereas that's not required in this case. So while there are a lot of similarities between the two in the way that CFPB put those collection requirements together, there are still subtle differences. When it comes to the application method, it being in person, by phone, mail, online, those would be selections that you'll make from the data points chart. And you can have the application taken by a third party as well. When you talk about the second bucket, the applicant credit information, this would be the credit type. What is the product? Is it a real estate loan, a line of credit? What is the credit purpose? Is it to stand up the new business? Is it to expand? That sort of thing. The amount applied for, census tract, the number of workers is something to pay attention to. This would include all full-time, part-time, seasonal, and contractors of the business. As I said before, the gross annual revenue, the time in business. And if the application is approved, the CFPB also wants to collect pricing information. And so this would be things like the interest rate, the origination charges, broker fees, and any prepayment penalties. And when it comes to prepayment penalties, they want to know whether or not there was an option to issue the prepayment penalty. So that's just going back to the beginning, they want to know if the access to credit is equitable. So when it comes to something like a prepayment penalty, maybe you do not issue the prepayment penalty in this case, but maybe you have the option to. And the last column would be the demographic data. These are required, except for that the CFPB did introduce a new discretionary data point for the applicant demographic data, being whether or not the business is LGBTQI+ owned as well. So in this column, you're gonna ask whether or not they are women-owned, minority-owned, or LGBTQI+ owned, and you'll also ask for the principal owner's ethnicity, race, and sex.
Excuse me. One thing to note here, Stephen, is that, and this is a departure from, I think, between the proposed rule and the final rule, and I think it applies especially to these categories. Initially, I think the proposed rule had indicated that there may be a requirement that lenders use visual observation to determine, collect, and report on an applicant's ethnicity, race, and or sex to the extent that that information wasn't provided. The final rule takes that away. So there is no longer any obligation to fill out that information based on visual observation.
Thank you. And going back to the prior slide prior to this one, the CFPB has issued a filing instructions guide. So they will update this regularly and publish this on the CFPB's website. And this is going to contain all of the technical information that your operations and your IT are going to want to know about how to format the data, where to go to supply the data, what other information about the institution there needs to be, and how to structure the data when it comes in. All right. So when it comes to the data, financial institutions can rely on the information that the applicant gives them, or that comes in from the appropriate third party taking the application when compiling the data. But if the institution verifies the data, then it must report the verified data. This would be like, for example, the gross annual revenue, for example. And financial institutions can reuse previously collected data if the data were collected within 36 months and the financial institution does not have a reason to believe the data are inaccurate. Now, when it comes to the demographic data, however, financial institutions are not allowed to verify this data. And they are obligated to use only and report only the information that is reported by the applicant on the application. As Bill said, there's no longer a requirement. This is different than the proposed rule, as well as HMDA, for example, that you select if the applicant does not select, then to assume that and report based on surname or visual observation. Now, it's very important, and the CFPB mentions this numerous times throughout the final rule. And so this is really key. I mean, the CFPB has said that they're no longer going to require that institutions submit the data or submit information about demographic data if the applicant does not supply it. But they've balanced this with a requirement that the institutions must maintain procedures to collect such data at a time and in a manner that are reasonably designed to obtain a response. And so they have stressed in an issued a statement as well, that a policy statement, that they're really looking for institutions to encourage responses. They are encouraging them to ask for the responses as early as possible in the application stage, and at other times during the application stage to try and garner responses. What they've included in items that are considered reasonably designed to obtain a response are ensuring that the initial request for the applicant provided data occurs prior to notifying the applicant of the final decision, that the request for applicant provided data is prominently displayed or presented, that the collection does not have the effect of discouraging an applicant from responding to the request, and that applicants can easily respond to the request for applicant data. And financial institutions must have policies in place and procedures in place to identify areas of low response. And this could be things like different response rates coming from different business units. Say, for example, that your credit card product tends to get a higher response, but your commercial real estate product gets a lower response. The CFPB would expect that you would investigate that and determine what you can do to improve response. This would also maybe be the case if a particular loan officer has a low response compared to other loan officers, looking into that.
And, just to kind of highlight this, I think this was mentioned a couple of times, but there was, I think, policy guidance issued on the same day as the final rule, where the CFPB is highlighting the concerns over discouragement, and really, I think, makes it a point to say that, amongst other things, it does plan on focusing some of its supervisory and enforcement efforts in connection with this potential discouragement item here. So it's really putting a lot of emphasis on, importance on, and really trying to drive the point home to financial institutions that there shouldn't be any effort or to discourage applicants from providing this data, and then in fact that there needs to be policies in place to make sure that you get or reasonably designed to obtain a response. So yeah, just keep that in mind, that the CFPB is going to be keeping a particular eye out for potential discouragement.
Yes, and just to reiterate, this is very important because another reason this is very important is because the CFPB has said in their timeline for compliance that within the first 12 months after an institution is required to comply, that any audits of the institution with respect to compliance will be limited to assisting the institutions in complying in good faith. But they exclude from that safe harbor any type of discouragement. So it's very important that the policies and procedures of the financial institution are consistent and as we keep saying, reasonably designed to obtain a response. Moving on to the next topic is the firewall. Something that came out of the proposed rule that a lot of people were surprised to see was this firewall requirement, the notice, I should say, of the firewall requirement. The firewall is in the statute, but what it says is that an employee of a covered financial institution or its affiliate shall not have access to the demographic data of the applicant's principal owners if the employee or officer is involved in making a determination concerning the applicant's covered application. So they have provided in the commentary various things that are or are not considered being involved in determining the covered application. But if the institution determines that there is an employee that is going to be involved and there's not a way to feasibly put up the firewall and protect that employee from having access to the demographic data, then the institution can still comply with the regulation, but they have to provide what's called this firewall notice. The firewall notice is spelled out in the new section of the regulation, and it must contain this language, specifically the first sentence of this section, that one or more employees of the officers involved in making a determination concerning your application may have access to the information provided in this form. The rule does also require that when collecting this information, the institution is required to say that they're required to ask for it, that they cannot discriminate based on it, and they cannot discriminate based on whether or not there is a response. Now, the CFPB has provided a sample data collection form, which includes all of the disclosures that we just talked about on the first page of the form. As we said before, if the employees are not going to have access, then you could remove the first sentence from the second paragraph. But some institutions may opt to just include all of the disclosures, even if they do have the firewall in place. Now, the form is kind of set up in sort of it's 2 pages in the regulation, but the second page could actually be multiple pages. So we'll talk about that in just a moment. But the first page has the information about the business ownership. So as we said before, whether it's minority owned, women owned, LGBTQI+ owned, or none of these above. The second column, it does also have a description of what that means for the applicant. And the second column asks, what is the number of principal owners? And so it'll be anyone from 0 to 4. The second page of the demographic form spells out the race, ethnicity, and sex. And this is different also from HMDA in that the African American, for example, there are sub-selections of African American. Now, if you would fill one of these out, or the applicant would fill one of these out for each principal owner. If the applicant fills out some of the data, but not all of the data, then the institution will report based on what the applicant selected. So the applicant can select multiple races, ethnicities, sex, or gender. And there's no requirement on the financial institution to correct that or investigate that. If the applicant only selects some of the information, just race, but not sex or gender, then you would report that as well. You'll just report what the applicant selects. Next, we can talk about the website notice and publication of data. So the rule allows for the CFPB to publish the data that's collected, and they intend to do that. They intend to publish it so that they can make it available to applicants and also other stakeholders that might be interested in looking at the data, and also maybe other regulatory agencies that would be interested in the data as well. They do not intend to aggregate the data, and they have set that in the final rule. And so that means that they don't intend to take an institution's data or several institutions' data and compile it only and publish it that way. Although the CFPB does have broad discretion to do that and to publish this data in any way that they would choose to do. In addition to publishing the data, they want to ensure that applicants are made aware that the data is going to be made available on the CFPB website, and that the applicant has access to that data. And so financial institutions are required to provide this notice contained in this new section 110C that spells out that the application data is made available on the website. And that has to go on the financial institution's website, this website notice, to publish this on your bank's website. And lastly about the rule is the compliance timeline. So what the CFPB has done is they have introduced a phased approach to compliance. So they are based on the number of covered originations that the institution has done in the prior 2 years, will determine when the institution is required to start collecting the data and when they're required to start reporting the data. The first institutions who have done at least 2,500 covered originations in 2022 and 2023 must begin collecting data October 1st, 2024, and they would collect the data through the end of the year, and then they would report that data for that fourth quarter of 2024 on June 1st, 2025. So that is 18 months from now that they'll be expected to begin collecting and reporting the data. There is, as we talked about before, a safe harbor grace period for the enforcement and audit by CFPB, but that does not apply to that discouragement. The second set of institutions, any institution that generates or 500, at least 500 covered originations in 2022 and 2023, and at least 100 in 2024, will begin collecting April 1st, 2025. And then any institution that generates at least 100 in both 2022 and 2023, and at least 100 in 2024 and 2025, will begin collecting January 1st, 2026. And so the collection is always going to be, or excuse me, the reporting is always going to be June 1st of every year. So there is quite a bit of a lead time in that case, so about 33 months. But institutions should start planning today on how they're going, determining whether or not they are covered financial institution, and what processes they are going to be putting in place to ensure that they're compliant by the deadline. And so with that, I'm going to send it back to Julie to close us out.
Okay, perfect. Thank you, Stephen. Yeah, so as we talked about earlier, wanted to give you a little bit more about who Compliance Systems is, some of the value that we bring, but then also how you can continue to engage with us, whether you're a client or not, or hopefully prospective client. But as mentioned, this session is just one example. Over the past year, we've really built out our market engagement, and Compliance Systems, another way we try to differentiate ourselves, of course, is extending our knowledge and really engaging clients in a variety of ways to keep clients informed, not only just with what is changing with our solution, but things that are coming down the pipe, as we just saw today. But we are now continually doing regular podcasts on a monthly basis, webinars covering a variety of topics. We've done in-person presentations, not only just with Michigan bankers, but Minnesota as well as Missouri, and have some industry conference sessions coming up this spring as well. Many of our podcast recordings are on our LinkedIn page, so definitely seek that out. Great resource just to kind of have another perspective on things that are happening or technology that's coming out. But a little bit more on, Compliance Systems. We are very nimble because our area of expertise is focusing on, how can we continue to better deliver. It's the compliance content that's existed, right, for years. But things are changing, and we don't sit still here. So we're constantly looking ahead at what the market needs, what we're hearing from clients, and doing a constant reinvestment back into our solution. Some of the things, shown here is what we've been thinking about the past 2 years and really governing our direction. But rising costs, as we're now going to have to face, how do you have some new operational processes, procedures, and education of employees to just deal with the Section 1071 rules. Rising costs across just maintaining compliance, or possibly investing in solutions internally. But changing consumer banking preferences, this is just escalating. You can still go back to that, Stephen. This continues to escalate at a faster pace. We've seen clients using mobile devices in some capacity, but that's really been rapidly escalated the past several years. And they're doing that not just to open an account, but that's spanning in across to other lines of business that touch the bank. Commercial, small business loans, having solutions to help solve for that. Establishing business deposit accounts, and maybe even treasury management services that a potential new business customer would want to do with your institution. So kind of having solutions in place that allow you to be responsive to those changing preferences and behaviors. And then really the last piece that we're focused on, in addition to the others, is asking banks, are those systems that you are investing in internally to help maybe operational processes across deposits, lending, compliance, are those also impacting the customer experience? And that's really that last mile in their establishing that relationship with you, that deposit account, closing on that consumer loan. Is it meeting them where they want to be met? Is it in user-friendly language and content that's not distracted by things that don't apply? So is that content that you're presenting them tailored? So encouraging banks to really consider, what is that customer experience as they are engaging with your bank. Okay, if we move to the next slide. We've seen the disruptors coming in the market, and those two are coming at a more escalated pace. Amazon offers consumer financing. Who knew that? PayPal offers working capital business loans. So, little or low cost of entry, but the advantages I think that banks have here is you have an established customer base. You have those relationships. So for, what we're looking ahead to is how can we help our clients have that ease of use for establishing accounts, for closing and originating consumer, small business, commercial loans, and how can we invest in different ways to offer that same content so that, banks are in that strong position and maintain that with your client base. Next screen, please. And so I wanted to just kind of give a little insight. As mentioned, we have over 50 different deposit and lending origination system partners. Some that have been around a number of years, many, really coming out with very cloud-based, digitally focused solutions. And all our compliance systems partners, stated here. So leveraging our latest technology that is cloud-based, that really does have ways to touch and enhance to make that experience with your customers more digitally focused, or at least more tailored to making their experience a positive one with the bank. So on the next screen, I just want to really illustrate and talk through for a moment what are the facets of what we call our technology. So with any of those deposit or lending partners, and, kind of fill in the top there with any one of those names. How is this different when we have a compliance systems client using any of those systems? Well, first and foremost, all of these steps here, which are used, and whether we're talking about establishing a deposit or an IRA or a consumer loan or a commercial loan, all of these take place within that single landing spot, within that origination system. Meaning you get to the doc prep phase, you're not having to leave that platform. You're not having to export that or log into something else where you risk a lot of data entry, errors, where you consume a lot of extra time that just simply isn't needed. So, utilizing their front end systems, once you launch the doc prep phase, does compliance systems software kind of kick in? And you really don't even know where that ends or begins because it is that single integration. So our software is immediately grabbing all the details of any transaction. Who's our account owners? What is the account being opened? We're going to intuitively know what is legally required to establish that account, title that. Or in the case of loans, who's our borrowers? What are our entities? What is our collateral? All that's already been identified in that front end system. Our software is immediately grabbing that once you launch that doc prep phase and analyzing it. So it's really kicking off a lot of powerful compliance analysis, assessing and determining, do we have all the necessary information so we can go on to select documents. At that point, then you'll have an identification of what documents need to come together to perfect that transaction. We're very holistic. So yes, everything is in compliance, federal, state, but we're also looking to ensure you have a warranted, enforceable transaction. So a lot of other protections and assurances in that compliance analysis happening. And then finally is that really granular tailoring, that dynamic assembly of not only the compliance verbiage to support each unique circumstance, but also us allowing clients a heavy, what we call configuration influence into that dynamic document content. So you're not, one size fits all here. Our clients are able to, add in different covenants, different provisions, have those automatically come in based upon certain parameters that you specify. So then you can really start to support, a varying portfolio of small business loans to more detailed commercial loans, all the while capturing any latest, compliance requirements or changes. So a lot of power and kind of differentiation in that end user experience, and a lot of that attributed to that integration and that technology we bring with those integrated partners. And then just on the next slide, just to help illustrate or show, what some of the things that we're focused on right now today that we either have delivered to the market or are planning so for this year. We've talked about the depth and breadth of the deposit to, the full spectrum of lending products, that we offer. But kind of just touching on some of those topics across each of those lines of business. Remote online notarization is another way to have that digitally lending package fulfilled. UCC e-filing, kind of right in line with that as well. So again, making it easier and quicker to turn those loans around and satisfy the borrowers, also hopefully increase more time so that more business can be processed on the bank side. But also kind of building out the line of business for things that banks have had to go elsewhere in the past. So, commercial and consumer credit cards, indirect goods financing, two more technology-driven features, mobile consumer lending. So rather than having lending documents be delivered as PDFs, this is HTML formatting, where now borrowers don't have to do pinch, zoom, tap on PDFs. It's presented in a very mobile, adaptive manner. And then mobile first automotive financing. So as you work with various dealers and automotive lending and have more of that indirect relationship, we're building out a very digitally focused, think of like a Carvana experience where it makes it easier for dealers as well as your borrowers to really quickly act and consume on those loans. And then across deposits, very much always been in the online account opening space, but kind of taking that output very similarly on the lending side with to the deposits with HTML, making it very easy for that presentation that always on, can open an account 24/7 and have new account holders, receive their compliance content, but do so in a way that establishes the account quickly and very mobile friendly. And then the addition of treasury management is really going and being well received for clients who are utilizing us for small business loans. Now you can also establish that deposit relationship in all those treasury management services. We provide the tools to create those what have been very historically expensive and lengthy to create treasury management content agreements and service addendums. We provide solutions to allow you to create that and have those be made available through any of our platform partners. And just rounding out, tax favored accounts for wealth management. And then as Secure Act 2.0 evolves, building out functionality for that. So really, compliance systems tries to position ourselves where you have consistent technology across multiple lines of business offered through various deposit or lending platform systems, really helps you create those efficiencies, obviously cost savings, but improve processes so that you're able to be more responsive to customers and borrowers. So I think with that, we will open it up to questions. If anyone would like to stay on, ask some questions, we do have some time, and we're happy to try to field that and engage in any discussion. I see there is a question in chat, Stephen. Are you able to pull that up or do you want me to read that?
No, if you read it, I can't see it.
Okay. Yeah, so question is, one of the exclusions from covered transactions is HMDA reportable loans. So we are not a HMDA bank. Could you give a brief description of what those loans may be?
Bill, do you want to take that one?
Go ahead.
So those would be your consumer real estate mortgage transactions mostly. And that's pretty much the most broad description I could give you. But HMDA is a data collection regulation with respect to mortgage transactions. And along the same lines as 1071 requires the data collection for race and sex and gender to fulfill sort of the same purpose that Section 1071 is doing. And so it's really interesting here when you look at 1071 because it's the first sort of consumer protection related, well, not the first, but it's the very large consumer protection related regulation entering into the space of business and commercial lending. Prior to this, there was ECOA and ECOA, which is Regulation B Part A, and now there would be a Part B, which is this data collection requirement. So there was always the requirement that there be no discrimination in the credit application, or that the applicant not be discriminated based on race, sex, and gender. But now there's the requirement to collect and report this data as well.
Yeah, and just as a little bit of additional color on that, so it is primarily consumer loan when you're looking at that, but there are instances where a commercial or business purpose loan may be HMDA reportable. I think sort of broadly speaking, if if the purpose of the loan is to purchase a single family residence, either purchase or I think improve a single family residence that could potentially be HMDA reportable.
Okay, and then there was a subsequent question to that too. It said, would we have to count HMDA loans towards the 100 or 500 small business loans?
That's a good question. So I think because HMDA loans are excluded, they would not be included in the calculation. That is my understanding because they're not a covered credit transaction. Or excuse me, they're not a covered credit application, I should say. And so, so no, they would not be included in that 100 number.
Okay. Separate question. What if our bank has under 100 qualifying transactions in subsequent years? Will we be exempt from the rule?
Well, the way I could answer that is everyone is going to be subject to the rule. But whether or not you have to report in a particular year will depend on the prior 2 years. So if you did 105 last year and 99 in the year before, you might not have to report starting in that time frame. So, but then going forward, it will be 100 in the last 2 years, every year going forward. So you kind of have to do this look back and determine whether or not every year, whether or not you're going to be required to collect and report. So if you're on the fringe of 100 or right about there every year, then it sounds like you would want to have processes in place to collect and report.
Okay. And then this is just my question, Stephen. So you said that everyone does have to collect the data. It's just those are the thresholds for reporting it.
Well, no, that's not exactly what I meant. I meant that the rule applies to everybody, but that when you're only covered institutions have to collect and report.
Got it.
So I guess it's a little bit of a nuance because the statute is out there and it applies to all institutions. But when an institution is considered a covered institution for the purposes of reporting that year, they do that look back. So, when you look at that slide where we had whether or not you were required to report beginning at X date, it doesn't mean that you are or aren't as of that effective date. You may not be required as of that effective date, but in the future you may be required to. And that's true in the reverse. So you may be required to report according to the timeframes spelled out, but then in subsequent years you may not be required to report depending on your number of originations in the preceding 2 years. So it is a nuance, and so. But thank you for asking that question, so I can clear that up.
Got it. Other questions that are out there? Kind of looking to see if anyone feels like asking or through the chat. Okay, here's one. Let's see. I guess we'll continue on the same kind of topic with the question that just came in. So question is, just to be clear, if a customer chooses not to provide the data information, unlike retail lending, the loan officers do not have to complete the ethnicity, gender, race, etc., based upon observations.
That is correct. And not only do they not have to, they're prohibited from doing so. So you are not permitted to assume based on the interaction or the surname what race, gender, sex. And so that answer is that is correct, and that is different than HMDA.
Here's a question. If we do participation loans with another institution being the originators of this loan, do these still count towards the number of loans?
I think so, yes. Yes, I think the answer is yes to that.
Yeah, the participant, the person that's purchasing the interest in that participation loan would not have to report this. It's just the originator.
Okay. Let's take a look, couple more. Here's another, back on the HMDA topic. To clarify, HMDA reportable loans are only excluded if the institution is a HMDA bank and is already reporting those loans under HMDA. That's the question.
Right, HMDA reportable loans that are being reported under HMDA are excluded, correct?
And I think the idea being that trying to streamline and prevent the duplication of efforts from a data collection and from a reporting perspective.
Yes.
Here's a question. Does the website mandatory posting have to happen before my bank is required to collect data? My bank is not required to collect until 2026. So the website does not need the required disclosure until then. Is that correct?
Oh, that's a good question. And I'm not sure. I don't have the answer to that on the time frame for the website. To be clear, I'm not certain if it has to be before or after. My understanding, though, is that the time frame for compliance also aligns with the time frame for the beginning of collection. So there in the date you would start collection would be the same date you would have to have the notice. But I would want to clarify that. I would want to confirm that.
No other questions yet, but we can wait.
Potential other questions to come in, Julia. There was a couple of things that I found interesting there. I wanted to bring up, and it wasn't really a great time during the presentation proper, but a lot of it applies or is related to the definition of the small business, and then what to do with multiple potential borrowers. So from an application perspective, if you were to get two unaffiliated small borrowers that were applying for a loan, the rule provides that you wouldn't need to collect the data for both borrowers and their principal owners. You would just need to have a sort of consistent way to identify the one of the borrowers, if there are multiple borrowers, to collect that information from, to compile and maintain and report data. I think an example that was given in the rule was, for example, if you have a procedure that says, I think something along the lines of, we're just going to pull that information from the first applicant or something along those lines. But what the rule is making clear, and the comments to the rule are that you don't need to collect the data for all of the borrowers and their principal owners to the extent you're getting multiple small business applicants on there. So there was also a note in that section in particular that if the applicants are affiliated entities, the rule already permits consideration of the affiliate's revenue and determining whether a business qualifies as small. I think that was another interesting thing that I found here is that, excuse me, the financial institution is permitted but not required to report the gross annual revenue for the applicant that includes the revenue of the affiliates as well. And the Bureau adopted, I think, the rather broad, expansive view of what constitutes an affiliate that the SBA uses. So yeah, that's something to keep in mind as to whether a business ultimately constitutes a small business based on the revenue, that there can be consideration of affiliate revenues in some of that, the determination from a small business perspective. So just a couple of things I wanted to highlight there.
Good points. Any other questions? Okay. I think we've completed the questions I'm seeing right now. Oh, let's see, one more. We originate SBA loans and have other business entities that are guarantors on the loan. Are we required to report information on the guarantor business?
The guarantor business, I think would be considered an applicant, so I think the answer would be yes. But I am not positive, so I would have to follow up on that. I think it comes down to whether or not a guarantor is considered an applicant, and I think there may be differing opinions on that in subpart A of ECOA. But I think that a guarantor could be considered an applicant, and if they're an applicant, then you would report.
Mhm.
But I would have to confirm that.
Okay. We'll be sure to track the chat output as well, so we can respond. Okay.
Okay, Julie, is this the best way to reach you with any additional questions? Stephen and Julia's emails are
Yep.
posted. Okay,
Yes, absolutely.
great. Okay, and I think that came across the chat as well, that you'll share the slide deck with me and I can share that with all the participants along with the recording
Yes, absolutely.
link. So, well, thank you very much, Stephen, Julie, and Bill for sharing your expertise and educating our members today. And thank you for your partnership. It's always a pleasure.
Yeah, thank you. Thank you
Thank you.
everyone for attending.
Thank you. Have a
All
great
right.
day.
Have a good day. Thanks.